So today I'll be presenting on a topic that is at the forefront of many people's minds and has been a mystery and been a lot of ink spilled over this question: what is money? So first I'm going to give a little bit of a context of why I'm going into this topic. So yeah, everything is kind of written up there, but I'll go through these points one by one. And for civil society and citizens, the reason why it's important, especially from our perspective as COFACE Families Europe, is that money is very political. It's a political topic, and invariably, whenever you ask for something, specific measures like increased social benefits or whatever, the typical answers that you get is there's no money, or who will pay for that? And so it's really key to understand how money works, where it comes from, how our financial and economic system works, to be able to answer have good quality answers to those typical things that come up, typical oppositions that come up to any of your policy recommendations. And it also is important in order to have reflections on how the current system could be improved, or some of the problems that are generated through a debt-based monetary system, how those can be solved. So the present training is not really aimed to propose any alternative to the monetary system as of yet. And it's just about exploring the question, what is money? And, but it does rely, of course, on certain premises and a certain underlying theory, which can be linked to the modern monetary theory of money. But it's not associated with the recommendations from that theory. And so the aim of the training is to enable everyone to understand what's happening behind the scenes whenever you take a loan, when you pay with your bank card, or when you listen to a debate about fiscal policy and monetary policy, and try to sort of understand from what they're saying, what are their ideological assumptions about what money is. So here's, you have a quote like, "Money is the most powerful and pervasive secular force on the planet, yet for most, it's a source of mysticism and mystery." So what you hear when you go to school is you have this textbook definition of the criteria that have to be checked in order to qualify as money. It has to be a means of exchange, which means it's accepted by people to exchange goods and services. It has to be a unit of account, which means you can count with it. Like, for instance, if you have gold coins, for instance, they could be a means of exchange, but it's very hard to count with them because you cannot really break them down into subunits. Whereas if you look at euros, you can count down to the cents, and you can break down the value of money in that way. And it's a store of value, meaning that it has to, well, basically, like 5 years from now, you have to have a reasonable assurance that you can purchase the same amount of goods with the same amount of money, basically. But of course, these criteria don't explain where money comes from, or even how money acquires those characteristics. Some of them are inherent to the monetary system. Like, for instance, unit of account, if you have abstract units like euros or dollars that are just a number, obviously they're a unit of account, but it doesn't explain why they're a means of exchange or a store of value. Now, the mainstream model, there's one model that I didn't even mention because I don't think it's even worth it. It's the financial intermediation model, it's called. It's basically that you have savers, they put money in your bank account, and then banks can only lend out the available savings. Now, that is, of course, a very outdated vision. The most accepted vision today is the so-called fractional reserve banking. That is, you have savings, but then banks can lend out a portion of those savings, and then the person that receives that loan deposits that loan into a bank, and from that deposit another loan can be made. And so you can it's sort of a kind of a multiplication of an initial monetary base. Of course, still no one explains where the savings, the actual savings, the initial deposit comes from. Did the state print the initial cash, or was it a gold deposit? So it's intuitive, but it's not actually accurate and doesn't reflect how it really works. And so now the references for the way money is created comes from the works of David Graeber, which unfortunately died not so long ago, but his work is really worth the read. Steve Keen, Richard Werner, and even also based on the admission by several central banks, first and foremost the Bank of England, which wrote in a little research paper, basically money creation in the modern economy, sort of confessing how it actually worked nowadays and how it's been working for a while. So in a very, very simplified manner, we're going to go in more complex as I go into the training, but money is simply a debt. So any money is debt, or a promise to pay, or an IOU, a recognition of debt that is traded back and forth between individuals. So the simplest example is if you help your friend move out from his home and you work there for 3 hours, there's a kind of social, unspoken, unwritten debt between you of reciprocal service. But you could actually formalize it by writing out on a piece of paper, I owe you 3 hours of my work, and give that as a voucher to your friend, which he can redeem for you to come work, or him coming work for you when you need help. And so in this instance, you're kind of acting like your own bank. It's called a mutual credit system, where everybody is their own bank and everybody can issue a kind of credit that other people can claim on their working time. Now, obviously, there's a problem. You can't really use these type of vouchers to ask a third party for a service. So it works between you and your friend, but if you bring a third party into the picture, for instance, your friend gave you a voucher, I owe you 3 hours of my time, and you're trying to give that voucher to someone else to clean your windows, for instance, and you say, well, just clean my windows and then ask for my friend to help you out when you need help. That's not going to work. The person's going to refuse the voucher because they don't trust necessarily your friend. They don't know your friend. They don't trust your friend. So there's the problem of trust. It only works between people who know and trust each other. And so a bank is therefore simply an institution which issues universally accepted vouchers to exchange goods and services using abstract numbers to represent value. Here, to start with, we're going to start with working hours or working time, and go into abstract values later, so it's a bit clear. So you have two people, for instance, an economy of two people. One wants to plant an apple tree, the other wants to plant a pear tree, but they can't do it on their own and they need somebody's help. So the bank issues vouchers for 3 hours of another person's time. So it's like a loan. And you can use those vouchers to ask somebody to help you. They receive the voucher, exchange vouchers, and respectively mutually sort of help each other out planting their respective trees. So now they've planted the trees, and they return the vouchers to the bank to be destroyed. That's when they repay the loan. And of course, banks then position themselves as inevitable intermediaries to even exchange existing goods and services. So if somebody has apples, the other one has pears, and they want to trade, of course, they could trade in a barter system, but we'll see later on that that doesn't really work in a modern economy where you have more than two people in a market. So how do they trade? Well, again, the bank just issues vouchers, for instance, 1 hour, 1 hour. In this case, it's still time, but of course, abstract units work better when it's actually for goods and not services. And so there's two vouchers created, and there's a contract, two times 1 hour of debt. And then they use the vouchers again to exchange those goods. And then the vouchers return to the bank and the contract is destroyed, the vouchers are destroyed. So this continuous creation and destruction of these little vouchers. Now, of course, again, let's complexify the model a little bit. In the examples before, we've combined the roles of employers and employees. In the real economy, the way it typically works is businesses take out a loan to start a business or even to continue in the business activity. Then using that loan, they pay employees to carry out some work, for instance, via salary, to produce goods or provide a service. The employees then spend their salary in the economy, which goes back to the employer, and the employer reimburses the debt. And you can see that, again, there's this back and forth kind of thing, like money is created or these vouchers are created. They're used to put people into action, to produce goods, provide services. And the money circulates in the economy for some time, and then it exits the economy after a certain period of time, which is basically when the debt is fully reimbursed. So you have the banker that Here you have an economy with three people, so it's a bit more complex. You have a fisherman, a baker, and a farmer. They each have 5 units of goods, like 5 fish, 5 bread, 5 corn, and they need to exchange, and of course they need money for that. So the bank lends them €100 each, and with those €100, assuming that the goods have the same price, like €20, they just exchange and end up with €100 at the end of the exchange, and then they can reimburse it. And at the bank side, you have 2 different values that are created. Minus 300, which is credit. You could say plus 300 because to the bank it's an asset. Credits are an asset, but let's just assume it's minus 300 for the consumer, and plus 300 in deposits. Because obviously when the bank lends you money, it sends that money to your bank account. And so it has both. It has the contract of the money that it lent to you, and it has your deposits. So ultimately the total sum of that is 0. So there is no money in the economy actually, because you take minus 300 plus 300, there's nothing. But for a temporary time, that money exists in the economy so long as the debt contract is alive. And so again, as I've said, one part, the deposits plus 300, are a liability. They represent the money that the bank owes you. What that means is the money on your bank account is a debt of the bank to you. You can go to the bank and ask for that money in cash, for instance. And to them, it's a risk because they don't necessarily have all the cash to be able to give that money to you. And the credit is an asset for the bank. It is a future, sort of a revenue that they're going to have because they're going to gain an interest on that, as you'll see later. And so you have this spaghetti bowl, basically, of various banks. If you have multiple banks, where you have an overlap of assets and liabilities, because obviously when you take out a loan, sometimes you move that money around. It doesn't stay within the same bank. So you have deposits moving around. Then sometimes also banks sell off their credits. That's what happened in the financial crisis, by the way, where many American banks packaged loans and then send them off to third parties. And so the economy, the global picture of who owes what to whom, and especially how money should be destroyed, like the actual steps in which money should be destroyed, like each money generated has to be destroyed after a certain period of time, which is the debt maturity, as it's called, is like this very, very complex spaghetti bowl, which is almost impossible to untangle because assets and liabilities move around. And so whenever a bank is in trouble, it's almost impossible to avoid saving it. Somebody has to take over the bank because otherwise there would be a part of the money that would sort of stay in the economy forever, which might cause inflation because it would not be destroyed according to the plan. So it's really a very, very complex kind of mess. It becomes a really messy situation. So then let's also look at economic growth and productivity growth. So when a loan is made, it's not just to exchange existing goods and services. Most of the loans taken out or supposedly under a capital system, normally you take out a loan for investments, not just for consumption. And investments means that in the previous picture, the fisherman had 5 fish, the baker had 5 bread and not 10 bread. And what each of them does is that it uses half of the money, half of the loans, to actually invest in a bigger boat or a bigger oven or a bigger tractor. And then that allows them to produce more of that good. And that's how basically assets in the economy grow. You have assets that are like machinery or assets to grow your business that are created, like offices, office spaces, plenty of other things. And then the number of assets, as in goods and services provided in the economy, grow as well. That's called productivity growth, and the total availability of goods and services. And that is actually, we'll see later, that is a necessity under a system where you have interest. So what about the interest? As you can see, when if you have an interest, for instance, of 100 euros, if the banker lends 100 euros and it asks for a 10% interest rate, repayable at once, because otherwise, if you start calculating APRs and stuff, you're owing 110 euros, but there's only 300 euros in the economy, and the total amount of money that has to be repaid is 330. So how do you deal with that? And the only way to deal with it is to have a sort of a rollover of credit into infinity, which means that older debts are paid with newer debts. So that means that in order to repay that debt, they have to borrow an extra 110 euros, and 10 euros from that 110 that they borrowed are going to be used to repay the interest on the previous loan. And if they invest their money correctly, then because the number of assets in the economy grow in parallel to the amount of money available in the economy, then you have price stability. So if they only used those new loans to exchange existing goods, then you'll have more and more money in the economy for the same number of goods going around, which means either two things, like the prices are going up or the level of debt is going up unsustainably to unsustainable levels. And so the current monetary system can be seen as I said, a rollover of debt into infinity. So older debts are paid with newer debts. It's dependent on economic growth, of course, because otherwise there's no way to repay the interest on loans. It's dependent on banks and credit, because they're the sole actors that are entitled to create fresh money, inject fresh money into the economy via making loans. And the stability of the economic system depends on a parallel growth of the economy and the money supply. Otherwise, you have inflation or deflation, various crises. So in the graph that I just illustrated there, the blue bars represent the total money supply, or the total amount of debt created as time goes by. And the orange lines represent the debt maturity, which means the rate at which that newly created money has to be destroyed. And if at certain points in time there is less money injected or created via loans, they would call that a credit crunch in the jargon, in the official financial jargon, then there is no fresh money available to pay for older debts, and that sets the whole economy into recession, and you have various problems going along with that. So you have a plummeting economic growth. And that's basically what happened also in 2008, is that suddenly banks stopped lending, or people stopped taking out loans because of the uncertainty, because of the instability of the system. And because there was no money injected into the economy, no fresh money, then a lot of loans defaulted, much more than just the mortgage credits. And here the choice of indicators to see if we're doing okay is the debt to GDP ratio. If the GDP basically is increasing at the same level as the debt, it means that you have a stability reached, as I was explaining earlier, about the amount of debt that is invested to create new services or products, which ensures price stability. If GDP stays flat and the debt continues to increase, then you have a problem, and vice versa. So here's a little illustration. I wanted to make it clear for you, a very simplified kind of economy. But in other words, the amount of money in the economy has to correspond to the availability for sale, either secondhand or in stores, of goods and services. As debt is repaid, money is destroyed, and the goods that were created with that debt should also exit the economy in one way or another. So here, for instance, we have a model of like a bank grants a loan to a business, 100,000 euros on the account of the business. And it has an asset of 100,000 euros, which represents the debt. We're not dealing with interest rate at this point, but just to illustrate. That business hires employees, buys raw material, and produces washing machines. 100 washing machines, which are worth 1,000 euros each, if you want to do the calculation, of course. Then the consumers, which are actually the employers receiving the salary, become consumers. They buy the washing machines from the business using their salary. And the business gets the money from the sales of the washing machines and then reimburses part of the credit. So after 5 years, you have only 50,000 euros left in the economy if there are no new loans being made. And the asset also has shrunk to minus 50,000. And then ideally, in order to have price stability, you have to have 50 functioning washing machines and 50 that are broken. Why would that be? Because if you create a washing machine that can last 100 years, and there is a second-hand market for those washing machines, and you create another 100 new washing machines, then there's still 100,000 euros only in the economy, but there are 200 washing machines now in the economy. And so you have too many goods that are available at any point in time compared to the money supply, then you would have deflation, which is the falling of prices, which is not very good for the economy. So how did it work before banks then? So barter never really worked, and in small-scale villages, and this is you read that from David Graeber's work. People kept tabs simply of who owes what to whom, and banks are just a way to outsource the creation of these tabs of who owes what to whom in a trusted way or a universal way in an ideal world. But there are certain consequences to that kind of monetary system that we're in. First, it creates a sort of an oligarchic system where banks, governments, and the ultra-rich are the three main actors that decide nearly exclusively what should be produced or provided as a service in the first place, and therefore have a disproportionate amount of influence and voting power, you could say, on what the economy looks like, on human activity. And then consumers have less of an influence via their choices because, their wages are compressed, they're over-indebted. But even if you want to vote with your money, since the available goods and services are there because there was a loan to create them in the first place, your variety of choices are restricted. And it's the kind of thing where you have the choice between buying Coke and Pepsi, basically. So the banks decide who get credit, including governments, because they do operate on financial markets, and because states finance themselves primarily via the financial markets. It's indirectly banks that fund them in part. They engage in lobbying, of course, which we have direct experience with, and to influence the government. The ultra-rich, of course, decide where to invest their money and control boards of big companies. They do lobbying, they control the media, and the government decide on the economic policy, laws, regulations, and fiscal policy and government spending. So this is kind of the environment, the government creates the environment in which exchanges take place. So in the current monetary system, money is injected into the economy only via private banks, via loans. Most money in circulation is therefore debt, of 95%. Here you have an illustration of the money supply growth, basically across time, from 1997 to 2018. And if money is not used for productive purposes, but for speculative purposes, like, for instance, stock buybacks, mergers and acquisitions, speculating on existing real estate, then it creates bubbles, deflationary pressures, and plenty of crises. So basically, if money is created just to inflate the value of the stock market, and it does not trickle down to the real economy where you're actually funding real businesses, producing real goods, then you have a real problem. And that's what we've seen also over the last few decades, is that the diminishing purchasing power of consumers has been compensated via the use of consumer credit, but that can only go for so long before it sort of bursts and becomes unsustainable. So one other way to illustrate it is that in the current system, if you take a 100 euro bill, you realize that 95 euros out of that bill represents a debt that someone has to repay. Now, using bills is not very accurate, because it's more accurately the deposits on your account. If you look at a 100 euro deposit on your account, 95 euros of that deposit is someone else's debt that has a certain maturity. Like, for instance, 5 euros needs to be repaid in a year, 20 euros in 5 years, and 60 euros in 20 years. And so this creates a natural demand for money, since people and businesses in debt will compete for that money, to get that money out of you, because they need to repay their loans. So there's a pressure on them to ask for your money. There's a natural demand for money, and that's where the value of money comes from. So when people say that because we've left the Bretton Woods and the gold standard, money is worth nothing anymore. That's not really correct. The value of money comes from the fact that since it's been generated with debt, there's a lot of people that are out there trying to recuperate that money that is sitting on people's deposit account in order to reimburse their debt. I hope that's clear, and maybe we can go into a deeper discussion about what that means later on. So some of the consequences of the current monetary system. One consequence that we've seen with the work of Piketty and other economists is the so-called trickle-up effect, the opposite of trickle-down. And that is that if you have these huge businesses, basically, which take on debt, they compress the wages of workers but pay very high dividends, and the investors simply inflate the price of the stock price of that company, or don't really use those dividends and don't really re-inject them in the economy. They just use them for speculation. Then you have a growing debt on one side, especially also consumer debt to be able to buy all the crap that's being produced, of course, and the ultra-rich going richer and richer on the other side. And we've seen that also at work during the 2008 crises and the decade after that, and also with this pandemic, is that you have a growing gap between the very, very rich and the very, very poor. And so this basically leads people back into serfdom, a kind of debt slavery in a way, is that you're just working to pay off your debts. And that's more true in some countries than others. In the US, for instance, it's very, very true. In the Europe, it really depends on the country. Another problem is the difficulty to transition to a sustainable consumption and production because of growth dependence. And here we have the whole issue of programmed obsolescence. And as I've explained with washing machines, if you create goods that last for 200 years without breaking, then the money that was used to create those goods, to bring them into existence, is gone because it's been repaid. But those goods are still around they're still in the economy, they're still turning around, they're still available, and that creates deflationary pressures. And so there is a natural kind of incentive to create goods that have a lifetime, lifespan that is that mirrors basically the creation and destruction cycle of money. And of course, the point that I was making earlier is that if you don't have growth, how do you repay the interest on loans? And then there's also the incompatibility of a debt-based system with certain business models. And this is very difficult to grasp in some way, but let's take the example on the left. You have an image of permaculture. You make an initial investment of, say, 10,000 euros to grow your seeds. And after that, you repay your loan, but you don't need any new money, because you are recycling your seeds, keeping part of your production to have seeds for the next season. And because you're working with nature, you're not requiring any other kind of investment. You don't need pesticides, you don't need tractors, you don't need to make any further investments. And if you're rolling like that, understand that you're creating every year, you're putting on the market a series of goods, for instance, fruits, vegetables, that there is no money to buy. So if you're in an economy where there's just food and nobody takes on a loan because everybody grows their own food and all they do is just translate a part of their working hours into creating that food, then you have a really big problem, because there's just no money available in the economy to account for the existence of those goods. Whereas if you look at industrial agriculture, you need a lot of loans and investment. You need to buy your seeds every year because they're selling hybrids that you cannot recycle basically the seeds to reuse them. You have to buy them each year from a company. You have to buy pesticides, you have to invest in tractors, and every so often you have to buy a new tractor. And so if you have an economy with only businesses that produce pesticides, tractors, and seeds, and on the other side you have farmers, then obviously there's money available to buy whatever they're producing, because the companies that they took out a loan to pay for a tractor, pesticides, and the seeds, that gets transformed into salaries for those companies, and that salary is then used to buy the food that the farmers produced. I hope that it's quite difficult sometimes to grasp, but understand that whatever is produced for free, which doesn't require any kind of capital injection, is problematic for a debt-based monetary system. Everything that enters into existence as far as a good or a service, typically in order to be able to be purchased by someone, has to come into existence via a loan. And so with that, understanding how the system kind of works, then we have reflections for the future. So how can we rethink the monetary system to make sure it serves the public interest and is indeed the common good, as Christine Lagarde said, the president of the ECB? Because right now money is basically managed like the tragedy of the commons, is that nobody wants to really discuss how it's created. Nobody wants to take responsibility for how it's created. And we're sticking to just price stability, which of course is very important. But it's like a sacred cow. We don't want to sort of think about how things are done. We just want to tweak things here and there. And the image there to illustrate is basically it's very close to the way a monopoly works, where you have a few winners, and then you just try to tweak the rules, tax them a little bit, or put new cards on the game to change the outcomes a bit. But you're not really rethinking the fact that we're playing Monopoly as a game. The way the fundamental system, the way it works, we're not calling that into question. We're just want to tweak it here and there. And then obviously the topics for discussion can be universal basic income. And of course, how you pay for universal basic income is very important, because paying it via taxation or via helicopter money creates completely different situations. Then you have the question of taxation, and I think we'll hear from some of our members about that topic later on. Monetary creation as such. Should private banks be the only ones being able to create the money that we use every day? I'm not talking about central bank money, which is a completely different manner, and we can go into that if you want. There's also the idea of credit guidance, which is more rules for how banks lend into the economy. So typically to make sure that they fund things that are worth that have certain meaning for society, like for instance financing the green transition, and setting aside part of the loans that they grant specifically for that, instead of just checking whether the business they're lending to is profitable and leaving it at that. And then you have new monetary theories like the relative theory of money, which I've already presented in a conference a few years ago at COFACE Families Europe. And you can also look at the Wurgel experiment, which is a city in Austria during the Great Depression, which created a special type of currency which lost value as time went on, as you used it, and re-injected periodically money into the economy via sort of helicopter money. And that also proved a very interesting experiment in an alternative way of creating money, and developing a resilient kind of economy, at least at a local level. And there are many other things that we could discuss also. We could discuss time banks, we could discuss local currencies, but this is just a first part in a larger discussion, is first understanding how the system works, what are the consequences of the fact that it works in a certain way, what are the outcomes, like for instance the concentration of wealth, the fact that banks have a disproportionate kind of voting power or decision-making process in which businesses actually come to life. One thing I didn't even mention, for instance, is the stranded assets issue, as it's called, is basically once you have corporations that grow to a certain size, like for instance the oil industry, and they owe the bank 60 or 70 or 100 billion, then there is a great incentive to make sure that they are kept afloat and they don't default on the loan. Because there's this saying, when you owe €1 million to your bank, you don't sleep. When you owe 100 billion to your bank doesn't sleep. And so they're really a systemic risk for the whole economy. And so how do you transition from the current situation to another world if you have these so-called stranded assets, or companies that would basically call a systemic failure if they were to default on the loan, and you sort of stuck into funding companies that are not necessarily good for the environment. So I'll leave it at that. If you have any questions, feel free in the Q&A. And I hope you found this interesting, and feel free to reach out. Of course, I'm available by email, not so much via phone right now because of the lockdown, but and COVID. But yeah, happy to answer any questions.